Hi, Ben. Thanks so much for all the hard work you and Dominique have put in. I'm thrilled to be here today. I want to thank everybody who's attending my session of this phenomenal event. Today, we're going to talk about financial wellness. My name is Chuck Privatera, as Ben said, but I don't think it's going to be the typical financial wellness conversation you may be used to having. So I'm hoping that you're going to learn a few things. I'm hoping that it's going to go beyond what you may be used to hearing about financial wellness and what it means to you, your employees, your organizations. So again, I'm Chuck Privatera. I'm from Westminster Consulting. The title of the presentation is What About Us? Diversity and Inclusion Blind Spots in Your Financial Wellness and Retirement Plan Benefits. So before we get into the presentation, and we'll speak a little deeper about the history of financial wellness, but generally speaking, this conversation comes from the fact that when an employee is financially stressed, they tend to manifest their financial stress in physical well-being and emotional well-being. So if I'm not well financially, then I'm going to have higher medical claims. I'm going to suffer from emotional stress and things that manifest themselves from poor financial health. And the whole conversation started with, if we can help mitigate some of these financial stressors, potentially we can mitigate the other issues that go along with the financial stress. I'm taking it from a different perspective, and I'm saying that financial well-being, good financial health, can actually help improve emotional and physical manifestations of other issues. So what do I mean by that? This next slide, it's not one that I'm thrilled about, but this is me in 2016. And I didn't come into some sort of windfall or anything like this, but I had obviously some physical well-being trouble, some emotional well-being trouble, and I knew I needed to make some changes and to improve both my medical and my emotional well-being. And I had, and what financial wellness is not, I didn't come into some sort of financial windfall, but I had an understanding of my priorities of my spending and where my finances, what was coming in, what was going out, and how to budget and things like that. So I was able to make some changes on the financial perspective that allowed me to allocate some resources to a trainer and a therapist. And so in my case, and I believe that this can be the case in many cases, my ability to understand and have a good grip on my finances was able to help me physically and emotionally. And this wasn't just like I said, there wasn't extra money laying around. I mean, I don't believe a lot of us have any extra cash laying around. Well, I'm just going to start spending, a few extra $100 on a trainer. I mean, that wasn't the case. It was saying, okay, we can chip away a little over here, a little over there. So I guess I want to take it from a more positive perspective that good financial health can lead to better emotional and physical health. And here's I'm living proof of that. So about 26 years ago, when I started in the financial services business, the message, I was following around the Grateful Dead. The messaging was, what is a stock? What is a bond? What is tax deferral? Why is it important? Company match. And that was all well and good. But unfortunately, today, I'm still following around the Grateful Dead. They've changed quite a bit. A few new faces, added a little diversity to the band, but the messaging, unfortunately, hasn't. And what we're seeing is this sort of similar message is you need to be saving in your 401k plan. You need to be saving 10 to 12%. And it's only speaking to a very small portion of the population. And so I'll move on to my last musical reference. Here's a picture of Pink, and she's really where it all starts from. I have a huge crush on her, which is why I've got her picture there, but it's okay because so does my wife. And we do love Pink, but the point is that she's leading our discussion today. And the song spoke to me. What about us? What about all the broken happy ever afters? And what about all the plans that ended in disaster? And as someone in the financial services business, this was always a concern of mine. We do a lot of work consulting with companies at the plan level, helping them pick the right funds and things like that. And we'll get into that in a second. But what about all the employees that are struggling to retire, that are struggling to save? And so let's sort of go into that a little bit now. So all across the country, at companies, and for Westminster Consulting, they're middle market companies with anywhere from 1,000 to 15, 20,000 employees. Companies will have a committee, and you may be on that committee, that oversees the 401k or 403b plan. And those committee meetings can vary. Very often it's someone from finance, someone from HR, someone from legal, operations. And we would, at Westminster, we spend 2 hours in those committee meetings talking about everything related to the plan, and certainly investments. And at the end of those meetings, we usually come up with a few conclusions. Maybe we need to swap out this fund for a better priced fund or a better performing one. But I've never walked out of one of those meetings getting sort of a high five from an HR person saying, wow, great move swapping out that mid-cap growth fund. That's really gonna change my life or improve engagement in the retirement plan. Just doesn't happen. And it would kind of, and so I would kind of scratch my head and say, you know, what is it that HR is struggling with when it comes to the 401k or 403b plan? And it always came back to my employees just aren't saving enough. So let's take a little bit of a deeper dive into that. So if we look at all Americans, the current, and average them all out, the average retirement account balance at retirement will be $218,000. By putting in this sort of arbitrary new investment allocation, which would be the best of all worlds in investments, we could save or add to that about $132,000, and that's under the perfect investment scenario. And then if we improved the current fee structure of the average plan to the optimal fee structure, we could add about $33,000, for a total of, bringing that average participant balance from 218 to about $400,000. So that's just fees and funds, and that's the work we do in those committee meetings. Unfortunately, the average American is going to need about $1.5 million, $1.6 million in retirement. So the fees and funds just aren't getting us there. So we hear a lot of things like, like I said, fees and funds. We hear about headwinds and friction, and, employees aren't interested in saving for retirement, or they have student loans or all these other things. And yes, that's true on the surface, but I think there are bigger problems. When I show this slide to most people, the first sort of reaction is, wow, this doesn't speak to me. I've given this presentation at SHRM events for the Garden State and all over New Jersey, Disrupt HR, and people kind of gasp because, yeah, sure, there's the typical, old white couple. And when I dig a little deeper into it, how many of you actually think that the woman here was the breadwinner? And I usually get a gasp, and I'm hoping that I'm getting a gasp from the folks in the audience today. The slide, the landing page, this is the biggest record keeper of 401k plans in the country. Their landing page was designed that way. It's designed to have the woman sort of, hand on the shoulder. And unfortunately, the reality of this slide is this is the reality of how we communicate to most Americans, and most Americans don't identify with this. So in my travels, I spoke to different people in diversity, especially around the New York metro area, because I wanted to make sure I wasn't causing a problem that didn't exist. I wanted to make sure that I wasn't being opportunistic and, trying to raise issues that weren't there. And I asked someone who was in a leadership role for a large diversity consulting firm, and she said, well, not only are there problems, Chuck, but even when some companies, when some of the financial services institutions get it right, they may, include Black or brown people or same-sex couples. But what you always see for retirement communications are couples. And there are some cultures that this right off the page doesn't resonate with. That there are some cultures that look at this and say, wait a minute, where are their families? Where are their children? They want to be surrounded by loved ones, and their picture of retirement is totally not this. So the reality is that the financial services industry does a great job speaking to sort of the, old white guys, because that's primarily what the financial services industry is made up of. And we'll get into to this a little further, but I want to dig into more granular issues. So student loan debt, and I mean, this is a broken record, but I'm going to give you a unique spin on it here. So you might want to just sort of pay a little closer attention, because this isn't about offering some new hot benefit that young people care about because they're so burdened with student loan debt. But the reality of it is, I had a client who came to me and said, we'd like to offer one of these. This is about 4 or 5 years ago. And I thought, oh no, here we go. Here's the shiny new toy. And they said, actually, no, this came from our board. It came from the diversity committee of our board. And they asked us, they said, you know, could you do some homework and find out if it's likely that our minority populations, or our Black and brown folks and our women are more likely to be burdened with student loan debt. And if so, find out if that's affecting their ability to contribute to the 401k plan. And so HR got, rolled their sleeves up, dug in, and guess what? They found out at their company, if you were a woman or a person of color, you were much more likely to have a much higher student debt burden, and you were less likely to be contributing to the 401k plan as a result. And further, you were more likely to not be receiving the full benefit of the company match. So this company looked at this and said, we don't have a fiduciary issue here, but we definitely have a diversity issue with our 401k plan. But for the fact that you are someone who is not white and privileged, you are suffering because you have higher student loan debts, and you're unable to reap the entire benefit of the compensation we're paying you. And so this became the impetus for this company to say, we have this diversity problem with our 401k plan. It became sort of an impetus for me to say, there's something more here. And we'll get to that in a minute. I just want to sort of round this out. A good first step, Abbott Labs. You've heard about this. I just want to cover this briefly. They had a private letter ruling. And basically what they said was, see, at Abbott Labs, they say to their employees, if you contribute 2% of your pay to our 401k plan, we'll match it 5%. And they went to the IRS and said, we're worried that some of our employees with high student loan debt burdens can't even contribute that 2%. So if an employee can show that they're paying 2% of their pay to pay off student loans, we're still going to put the 5% in the 401k plan. Now, the reason they needed to go to the IRS for that is because that under regular rules is not legal to do that. And there's a lot of reasons why. And what Abbott Labs did here, only they can do. That's what a private letter ruling is. But this is a good first step. This is a recognition that we can't let our employees that are burdened with student loans not be participating in the retirement plan. So there's more to come on this. There's legislation. I've been down to Washington, D.C. on behalf of SHRM to lobby for certain legislation, and hopefully we'll get there soon. But this did get me to thinking, if there are diversity issues around this, what kind of other diversity issues are in the retirement plan, financial services industry? And so I had a chat with my friend, Lawrence, who also happens to be my trainer, who transformed me from the guy you saw on the first slide to the guy who can squat 385 pounds and deadlift 400 pounds. But I asked Lawrence told me he contributes 12% to his 401k plan. And I asked him why. And you have to understand something. Lawrence and I came from very different backgrounds. Lawrence had 4 different homes in high school. His mother took her life while when he was 12 years old, and stability he didn't have, like what I was used to growing up. And so what he said was, Chuck, I view the 401k plan as my opportunity to provide a safety net for myself that I never had. Boy, wouldn't that be amazing if some of the large financial institutions or 401k plan providers came out with that kind of messaging rather than pictures of golf carts and lake houses. How about building yourself the security net? Or if you're, first generation college graduate or first generation, advanced degree graduate, this is a way to provide yourself with a nest egg to start building security. And the communication that I believe, when I'm in rooms in the New York metro area, would speak to a lot more people in terms of engaging them in the retirement plan discussion. So thank you, Lawrence, for opening my eyes to that. So let's talk about savings priorities. This is a study that's cited in the back of the deck that was done by Prudential. savings priorities. Asian Americans want to be able to take care of their parents or their family members. These are all #1 priorities for these cohorts. Black Americans want to provide college tuition for their family. Latinx Americans want to keep up with their current expenses. The LGBTQ plus community wants to maintain a standard of living for their family if they can't provide. And white men and women want to have enough savings to last through their retirement years. Of course, what's the messaging we always hear is save for retirement. We don't hear anything about the rest of these, or we may hear them anecdotally or as an aside, but these are the #1 priorities for way more than just white Americans. So I think there needs to be a reckoning from the financial services industry. I mean, me personally, I live in a middle-class suburb of New York City, and I look around my street, and my wife and I are older parents of a young child. Across the street from us is a retired couple with grown kids. Next door to them is a family our age with 4 boys between the ages of 12 and 20. Down the street is a single woman who is raising her only child on her own. She's about 40. We're all white and we all live in the same street, yet all of our needs are different. If you're speaking to us all about saving 10 or 12% in our 401k plan, we're all going to have very different answers as to why or why not that fits for us. So if we're not meeting the basic needs of people in the same sort of homogeneous world, how can we possibly be getting even close to managing to meet the diverse financial needs of everyone else? And so that's really what I want to continue to focus on throughout the rest of this presentation and in our delivery of financial wellness services. So this is eye-opening, to say the least. 4 in 10 American households with children under the age of 18 now include a mother who is either the sole or primary earner. Of people age 65 and over, 70% of men are married, compared to just 45% of women. And this has to do with several things. Men are more likely to get remarried after a divorce. Women live longer. But the reason I show you this slide is because of this slide. Yikes. So given that women are more likely to be alone in retirement, live longer, and suffer from past gender wage issues, which will affect their Social Security in retirement, yet here we are. Women are going to need more in retirement, and they have much less. Their median balance is 1/3 of what men carry. Their deferral rate is half, and so deferral rate is even adjusted for income because it's a percentage, and obviously their median income is much lower. So this is what really sort of knocked me back when I saw this, because I thought this, by the way, is for women and men aged 21 to 37. So in my narrow 401k world mind, I felt that as the conversation around 401k plans evolves, this would have been evolving too, and it's not. So this is frightening. And so why does all of this matter? Well, certainly 67% of all employees report some level of financial stress. Okay, that's a huge number. And this, by the way, was in a study from PricewaterhouseCoopers, 2019. This is when the economy was technically booming. 67% of your employees report some level of financial stress. These are employees that are working, okay, because these are workplace surveys. 49% of these employees report spending 3 hours a week or more at work dealing with their stressful financial situation. Okay, so this means that I am so stressed about my finances, I'm either working with some sort of credit counseling, trying to fend off creditors, trying to do some refinancing, or whatever I have to do to stay afloat. And this stress is causing me 3 hours of productivity a week. That's real. Those are real numbers. And then finally, why this matters. Financial precarity is sort of a new term. And financial precarity is the idea that there's a certain percentage of the population out there that is so consumed by their finances that they have trouble making decisions. They are overwhelmed. And there was a study recently done of drivers, and they measured a group of over 1,000 drivers, and they isolated the ones that they felt were suffering from financial precarity. And in this particular case, those drivers were 12 times more likely to have an accident on the job. In this particular company, these insurance claims, the cost was over $1 million. So all of this matters from a, we want to be a good employer. We want our employees to come to work feeling safe and secure and well and stress-free, but it's also costing us money as a company. There's real money here. So let's have a little chat about what financial wellness is not. I call it financial whatness. So it's not cheap or free. And why I say that is because very often we find financial institutions willing to send in advisors to give advice, to do free webinars, do free budgeting seminars on site. But if it's free, those folks have to get paid. And I'm not knocking those individuals. This is how they make their living. And they want to convert some of these conversations to individual clients. And that's fine. The problem is they're going to be drawn to, by virtue of the way they get paid, to work with people who have more money. And those just aren't the people that are struggling at your company. And so while they may try to help the folks at sort of the bottom end of the income spectrum, how much time can they really spend with them on helping them reorganize their credit card debt or budgeting or setting up emergency savings, because they just don't get paid that way. And so that is not, in our definition, financial wellness. It's most cases it's not effective, very little participation, and it's not helping the people who need it the most, who are going to impact the organization the most. It's not well defined, not sure what it means, not sure what we're trying to deploy here. And it's not well designed. This goes back to, it's generally serving executives more than, or higher income folks more than the lower income folks. It's not scalable, so it hasn't been to this point. Larger companies or mid-market companies like the ones we serve, very difficult to get boots on the ground and to scale to really do an effective job. Again, the type of either free financial wellness or financial whatness is not free from conflict, because generally those folks will be there for free to sell a product, and that would generally be to people who can afford those products. It's generally not working for people who need it the most. Again, individuals who are really struggling. And so let's just go back to a small history of what financial wellness is, a brief history. This is actually a study done by a friend of mine, Liz Davidson, over at Financial Finesse, and they studied the employees of Aetna at the time. This was in 2014. And what they found was that, so they tracked the medical claims of over 3 years of the population that took advantage of on-site financial planning versus the ones that didn't. And they found a dramatic difference in claims, and the claims were what you would expect. So the people who did not take advantage of financial planning, for 3 years, they tracked their medical claims and they had a 19% year-over-year trend, versus the ones who did take advantage of the financial plannings and planning, and theirs was about 4% year-over-year trend. Now, there's not a cause and effect here, but there was absolutely a correlation. And what it meant, what they showed was the claims themselves were neck and back, insomnia, depression. So all the things that you would expect would come from financial stress. And so most companies wanted to do something about it, so many vendors complied. They threw a lot of different technology solutions, a lot of different things that I really wouldn't call financial wellness anymore, and they really diluted the financial wellness conversation over the last few years. At a recent conference of financial advisors, I was there, and they asked the room what financial wellness was, and I heard things like having a budget, saving 12% for retirement, having enough life insurance. I was like, oh my God, no, that's not it at all. It's the idea that if you are not financially well, if you suffer from financial stress, it affects your health and your well-being and your ability to work and your emotional well-being. So when financial advisors don't even know what financial wellness is, that concerns me a ton. So what should it be? It should be able to address each individual needs. It should be free from conflict. So really the ideal situation is where a company charges a per head per user fee or something, a flat fee to come in and do financial well-being consulting. It needs to be able we need to be able to meet the employees where they are, no matter what their needs are, and help them solve their problems. So it needs to be able to reduce employee stress, improve absenteeism and presenteeism. So there was a study that Prudential did. They followed the financial well-being of a group of people who traditionally was responsible for 2 weeks of unplanned leave per year. They tracked them over 10 years, gradually trying to improve their financial well-being. And at the end of 10 years, they were down to 1 week of unplanned leave on average. Again, real money, huge improvement based on helping them with their financial related hardships and well-being. So scalable, it has to be a combination of technology that ties into coaching, and the coaching has to be just distributed many different ways, either via on-site, via over the phone, through Skype, through technology, Zoom. It needs to be reasonably priced. It has to be measurable. I think it would not be meaningful if it did not improve employee engagement. And certainly you want it to have a combination of high touch and high tech. So when I go back to some of the meeting the diverse needs of our employees, we've rolled out some of these financial wellness platforms and realized that the people who need them the most are typically Black and brown people, women, single working mothers, many who come across those intersectionalities. We found many people that identify as LGBTQ plus have said to us, this is a way more constructive dialogue than I've been able to have with a financial planner who doesn't truly understand my needs. We view it as, look, everybody needs 3 simple things when it comes to beginning your financial wellness conversation. And it's, I need to prioritize my spending. I need a budget, and I need a coach to help me through complex financial decisions. And so that's ideally what your financial wellness platform should look like. When people ask me about the diversity issues in the financial services industry, I mean, I spoke to a group of wealth managers in New York City in January about diversity. And I walked up onto stage, there was a couple hundred people in the audience. About 10 were people of color and about 5 were women. And I kind of just chuckled and said, well, this is where your diversity issues start. So we're working on it at Westminster. We're trying to be an ally and trying to deliver the same experience for everyone and meet them where they are, and whatever their needs are, help them with whether it's credit card debt, emergency savings. But this is a financial wellness conversation that goes way beyond what I think you're typically used to hearing. So this is your conversation, HR. So speak up, be brave, and challenge your committees, challenge the people that oversee the 401k plan, challenge your vendors, and challenge your advisors. So disrupt your 401k plan. You know, what about all of us? What about all of our happy ever afters? And let's make sure that none of our plans end in disaster. So I want to thank you for spending time with me today. I hope you'll ask questions. I'm here and I'm available. Go ahead and ask them in the chat. And I thank you for your time, and I hope you have a great rest of the conference.